Welcome back to the channel. In this week's episode, we are going to be continuing the series all about tax write-offs and the most common categories that your expenses can fall into as a small business owner. And we are going to be talking about insurance and retirement contributions today. So let's dive on in. Hi, I'm Heather, a wedding and senior photographer in Lancaster, Pennsylvania, and on this channel I help other photographers manage and understand their taxes as a small business owner, streamline their systems so that they can spend more time with family and friends, and I also love to give you a sneak peek into my life here and there. But before we continue into this series about tax write-offs, I do just want to remind you that down in the description is one of the freebies that you can grab that walks you through the most common expense categories that we're actually going over in this series. It's a perfect way for you to follow along, add notes, and then reference back to these different categories throughout the year as you start categorizing your own expenses before tax season comes. So make sure to grab that below and let's dive into the next two categories, which are going to be insurance and retirement contributions. So let's talk about insurance as a tax write-off. Now, we all know that insurance can be quite expensive, especially when you are self-employed and paying for it out of pocket every single month. But you do get a opportunity to use it as a tax write-off depending on one stipulation. You can only use health insurance premiums as a write-off for the months that you or your spouse are not eligible to participate in an employer subsidized health plan. What that means is if your spouse works at a job that offers benefits through health insurance for both him and you, then unfortunately, those months that you fall under that, you're not able to put your own insurance that you have to pay as a self-employed business as a write-off in your taxes. But if you do not fall under that category where your spouse has the eligibility to participate in one of those plans, or you are both self-employed, then your premiums can be used as a write-off. Now, if you fall under that category where it can be used as a write-off, those benefits include medical premiums, dental premiums, and also some qualifying long-term care premiums. So make sure you're checking with your accountant because you could be getting a tax write-off on several of your health premiums that you have to pay monthly for you, your spouse, and also your dependents, depending. So make sure you're chatting with them, letting them know what you pay for health, dental, and long-term care and who you pay it for, and they'll be able to walk you through what parts of it can be used as a deduction towards your tax write-offs. Now, the other category that we're going to talk about today is retirement contributions. And I'm going to be diving into these three different main ones that people start off with in another video, but I just want to touch the surface on what can qualify as a tax write-off as you start working on your own expenses in your business and categorizing them so that you're ready for tax season. So the three main ones are traditional IRA, Roth IRA, and SEP account. There's other ways that you can save money for retirement, but those are the three we're going to talk about today. Now, two of them, as I mentioned, are IRAs, the traditional and the Roth IRA. The difference between the two of them is that traditional IRAs are tax deferred, which means when you put a contribution into that retirement plan, you don't have to pay tax on it until you go to take it out, which is typically around 59 or above. The Roth IRA, you pay tax on right when you put the contribution in, but then when you go to take it out, it's tax-free and you can pull it out without having to pay taxes. Now, the SEP account that I mentioned is very similar to the traditional IRA in that aspect where it is tax deferred, so you don't need to pay tax on it right away, but you will pay tax on it when you go to take out the money that you need. Now, how to decide which one to do? There's many factors, but when we just talk about tax write-offs and how you can get a deduction on your taxes or your income for that year, how you can bring that number down, which helps with how much you have to pay in taxes for that year, the traditional and the SEP will actually pull down your income for the year because that money is getting put into your retirement contributions and is not taxed. So that helps bring your income down for that year. But then when you need to pay tax on it later on, that is going to come into effect for those taxes for that year when you're 59, 60 or plus. Now, the Roth IRA, you need to pay tax on now. So when you put a contribution in, that year's taxes, you'll need to pay tax on it. But later on down the line, when you go to take it out, you won't need to pay any taxes on it. So the way to think about it, and something to discuss with your accountant or even a financial advisor, is if you're setting yourself up for retirement to be almost better off than where you are right now financially, it may be beneficial to pay tax on that money now because you'll be at a lower tax bracket than later on. When you go to take the money out, you could be at a higher tax bracket and need to pay more on taxes for it then. So that's just something to chat with your accountant about when you're going to set either traditional IRA, Roth IRA, or a SEP account up. There's also things about how much you can put in yearly, which one is beneficial for different situations in your life. So make sure you're talking through all of those different factors. But for today, when we're talking about tax write-offs, the factor that you might want to consider is that tax bracket and when it would be better for you to pay taxes on those contributions will then lead to which one you should select. So the three main ones that we're talked about today are traditional IRA, Roth IRA, and SEP. Now for me, I started with a Roth IRA and then I added a SEP account several years later when I was making more money and putting more into retirement than I was able to with the Roth IRA. For instance, in 2023, Roth IRAs have a cap for an individual of $6,500. So I was wanting to put more into the account than $6,500. So then I added a SEP account that I could put more into a retirement plan after that. Now, I know I got a little bit farther than I said I was going to, but I just wanted to explain that and let you know the steps that I took and which one I did first and then which one I did after that. If you have more questions about that or insurance, go ahead and drop them down in the comments and I would be happy to answer those. But I do just want to remind you, make sure you are talking with your accountant or financial advisor about these because different factors can determine which one you should do based off of your personal life or your business, but then also the state requirements can affect some things as well. So make sure you're just chatting with them and make sure that you're doing the correct plan that works best for you. Now, next week, we are going to be diving into 2 more different categories for your expenses that are most commonly used throughout the year for your business. But in the meantime, make sure you grab that freebie down below. Let me know if you have any questions and hit that subscribe button so that you are the first to know when the next video comes out next week. All right, guys, thanks for tuning in and I'll see you later on. Bye.